Good morning, Monday, October 13th, 2025. I am Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. It has been prepared by me for use by both investment advisors and individual investors. Regardless of which you are expected to make your own investment decisions. Also, nothing contained in the presentation should be treated as advice, tax, investment, no recommendation for the purchase or sale of any securities. Everything is for informational purposes. The views expressed are mine and mine alone. They may differ from the views of CFIA's parents, affiliates, or other portfolio managers at the firm. Well, things were going really well until we got back into heated trade rhetoric as the president decided to re-engage discussions with China. They didn't go particularly well. There was a threat of an additional 100% on Chinese imports. Now, that caused the market to sell off very aggressively. Unwinding of levered bets spilled over into crypto and other markets. But this is a game plan. This is a path we've seen this president take in both terms. Machiavellian positioning, turning it, and ultimately settling down over the weekend. So here we are Monday morning, and we're looking at a Dow that's up about 600 points and an S&P 500 that's up 100 points. I was not particularly concerned with this action on Friday. It did see bonds catch a little bit of a bid there. The AG was up 33 basis points on the week. Long-dated treasuries, we got down to like 405, 410, I believe, on the U.S. 10-year on Friday during that sell-off, which just goes to show you that the U.S. Treasury market always will be and remains the safe haven trade. When risk assets are selling off, U.S. Treasuries catch a bid. That is one of the benefits of being the world's reserve currency. We had a report scheduled for the August trade deficit, but that was delayed due to the U.S. government shutdown. Consumer credit was not delayed. They say that consumer credit was basically flat in the month of August, rising $360 million. The estimate was for $14 billion on top of an $18 billion gain in July. Revolving credit, i.e. credit card debt, fell about $6 billion. So that was very interesting. On a separate note completely, but I think related, there was a Fed survey in September, New York Fed to be exact, which revealed that consumers are at the highest level in a year of believing there's a real possibility of job loss. That anxiety or lack of confidence in job security is likely what fueled consumer credit to be flat-ish on the month. Regular weekly claims for unemployment, which had been in the 220, 230, 240 range for quite some time, a couple of years, were delayed by the U.S. government shutdown. The University of Michigan, however, did release their October Consumer Sentiment Survey. Not too good there. We've just been in these doldrums here for a very long time. You got to go. We're now well lower than where we were during the COVID-related shutdown period. Current conditions rose just a tad to 61. Expectations continued to fall. So people are worried about job loss and continue to be worried about inflationary issues. Despite that, despite the inflation remaining above target, despite the fact that we're very worried about inflation, the Fed has got its eye on the other part of its dual mandate, which is the labor market. We've seen significant softening. We now know consumers are worried based on their credit spending and based on Michigan's sentiment surveys. The Fed is likely to cut interest rates again because of that, 25 basis points this month when they meet on October 28th and 29th. The implied Fed funds rate there, it says 386 by the futures market. Really, it's going to be about 4%. And then on December 10th, they're expected to meet and cut another 25 basis points. That would get us down to about 375. January, you can see there, kind of up in the air, not really sure. And then that moves on, starts to get a little bit bigger odds again as you get into March of next year. Why would the Fed not? If the jobs market is slowing so much, why would the Fed not just cut interest rates? I think it's a question of where the neutral rate is, the rate at which neither stimulates the economy, providing inflationary pressure, or destimulates or mutes the economy, right? We just don't know. And inflation remains high. However, a little bit of hope here. You can see this is the break-even 2-year index and the break-even 5-year index. And in the last, let's call it week or two, you can see starting to roll over. This 238 on the 5-year break-even, you can see we have not been below that really since the summer when things were looking better on inflation. So that was a real positive development last week. You can see that's why interest rates have come down. That's why expectations for Fed cut still remain very high. So the question is, can these 5-year and 2-year inflation expectations get down lower into this area, to the 2% range, so that the Fed could feel free to cut? Well, they may get there on their own just because the economy slows down. The other issue that sort of came front and center is, you just got a little bit of some tough trade talk, nothing we haven't seen before. On Friday, admittedly, it was one of the biggest trading partners there are. It's with China, a very large economy, very important trading partner. But that sent markets into a tailspin on Friday. And one of the reasons for that is because valuations are still very high. This is one of my favorite graphs to look at. We look at the yield on the 10-year Treasury, the blue line. That's the risk-free yield. That's what you can get without any risk, loaning money to the United States Treasury. For 10 years, 4%, 4.03%. Okay, now we're going to compare that to the earnings yield of the S&P 500. It actually pays less, and of course it has risk. The risk is those earnings could go down, they could disappoint, they could fail, we could get into a recession, all of those different things. So typically what we say is when the yield on the risk-free, the blue line, is above the orange line, then the stock market is overvalued or the bond market is undervalued. But this is what I like to point out. Are they over or undervalued, or are they just really efficiently telling us about the future? Perhaps it's the latter. Perhaps the earnings yield being way down here is a reflection of the confidence that investors have in the stock market. After all, we start earnings season this week. And if earnings come in better than expected, which they have been doing for quite a number of years now, and if AI continues to deliver massive productivity gains and margins remain high or even go higher because of the productivity gains delivered by AI and technology, then perhaps we quickly earn our way into this. Because the 4% on that 10-year Treasury, I know this is getting busy here, but the 4% on that 10-year Treasury, that's locked in and guaranteed. It can't go higher, it can't go lower. But the earnings growth of the S&P 500 companies can certainly do both. And so to me, this tells me that it's a reflection of the amalgamation of investor views suggesting great confidence in future earnings. We move on. Economic data this week, nothing today. Monday, Columbus Day. The bond markets are closed to celebrate Columbus Day. Small business optimism on Tuesday. New York State manufacturing. Fed beige book. That's the board book, the meeting book that comes out ahead of the October 28th and 29th Fed meeting. Initial weekly jobs claims are expected at 2:30, but likely not reported. Retail sales, producer prices, unfortunately expected up 0.3%. Philly Fed. Housing, still miserable for the housing sector, as that's residential real estate is just generally locked up at the moment. Housing starts and permits remain fairly low. Import and export prices on Friday, along with industrial production and capacity utilization. And I got to say, capacity utilization down in the 77.3 is a not very inflationary number. You don't really start seeing a correlation to inflation pickup until capacity utilization is above 80. We're down to 77.3. That is also a positive for those that are watching the inflation issue. Okay, this is a podcast. This is a YouTube video. It's every Monday morning. Please catch us, subscribe, thumbs up, like, tell a friend. Thank you for tuning in, everybody. I'm Herb Morgan. We'll be back to you again in 1 week.